SuperMicro stock has surged over 1,200% in the last 5 years, and despite all of that hype, my valuation shows that the stock could still be significantly undervalued. After modeling a 10-year revenue and free cash flow forecast, my fair value lands at around $104 per share, which implies a 58% discount compared to where the stock trades today, and suggests an estimated annual return of 21% per year. On top of that, I'm giving SuperMicro stock a buy recommendation and 4 out of 5 stars as my final rating. But how can a red hot AI hardware stock be trading at such a steep discount? In this video, I'll walk you through 4 key parts, starting with the business model behind SuperMicro, diving into the financials, and then exploring both the bull and the bear case valuations, and finally looking at the technical setup to help you decide when to potentially enter the stock. So yeah, let's jump in. And to start off, let's look at a snapshot of SuperMicro over the past year and see how has the company performed. We can see that both revenue and EBITDA have grown massively, and we see an EBITDA margin of 8%. However, at the same time, the share price has actually declined by 51%, showing us that the company is becoming much more attractive on a valuation basis, and the company is also headquartered in California in the United States. But the question then is, what is it that SuperMicro actually does as a company? So SuperMicro Computer, ticker SMCI, builds ultra-optimized servers and AI infrastructure. They've become one of the go-to hardware partners in the generative AI boom. They work closely with NVIDIA to design AI data center systems that maximize performance per watt, per dollar, and per square foot, which has made SuperMicro the hardware supplier of choice for hyperscalers and enterprise customers trying to ride the AI wave. Unlike many AI stocks with high hopes and no profits, SuperMicro is highly profitable and growing fast. Revenue is up over 3 times in just a few years, and margins are expanding thanks to their modular, customizable systems. And yet, despite all of that growth, the stock looks deeply undervalued. This partly due to investor concerns of volatility, supply chain challenges, and skepticism about whether AI hardware demand can really be sustainable in the long term. But in my point of view, the bull case is quite clear. We have AI infrastructure tailwind. SuperMicro is riding one of the strongest secular trends. Every major data center needs scalable systems. We also have a moat. Their modular designs allow clients to tailor systems to specific workloads, which drives margins and builds customer stickiness. And lastly, we also have strong profitability. Unlike many hypergrowth tech firms, SuperMicro already has healthy margins and a solid balance sheet. However, it's not all perfect, right? We have a bear case as well. First of all, we have AI hype risk. If the generative AI boom cools faster than expected, then SuperMicro's revenue could take a massive hit. We also have hardware commoditization. While their systems are currently differentiated, competitors like Dell, HP, and Lenovo could potentially catch up. And lastly, we have stock volatility. SuperMicro stock is extremely volatile, making it tough for investors to stomach drawdowns. Okay, so now we have a sense of what SuperMicro does as a company. Let's move on and look at some historical financial data of the company over the past 5 years, which we'll later use as inspiration for our assumptions in the valuation. And here we can see the revenue in blue and the EBITDA in green. And we can see, yeah, revenue has grown consistently each year at 46% per year on average, and EBITDA has grown at a massive 82% per year, right? That's great to see. The company is not only growing its revenue, it's also becoming much more profitable at the same time. Now, let's also quickly take a look and see if that is any risk for investors going into the company today. And here we can see the debt sustainability of SuperMicro over the past 5 years. We can see debt in purple and we can see excess cash in green. And we can see here that, yeah, debt has indeed grown, but so has excess cash as well. Perhaps not at the same pace, but we can see that the company has more excess cash today than it has debt, showing us that debt really is no issue for us as investors. We can see the debt to EBITDA margin, which shows us how much EBITDA we need to pay down any debt minus any excess cash. And of course, that's 0 times at the moment. As we later on also will look at the free cash flow of SuperMicro in the valuation, let's also take some time and look at the historical data we have for free cash flow as well. And here we can see revenue again, right, in blue. And instead of EBITDA, we can see the free cash flow to equity. So that's the relevant free cash flow for us as equity investors. And here the picture isn't as good as we saw before, right? Yes, we can see revenue has grown, but the free cash flow has declined by 6% per year, showing a high discrepancy between the company's earnings and its free cash flow. This also shows us that the company is investing heavily in its systems and hardware for the future, sacrificing its own free cash flow. Now, the final chart I would like to show you has to do with the share performance of the company in the past 5 years. We can see the average share price here, right, in the dotted line, and we can also see the number of shares outstanding within the company. Now, these are in millions, also showing us that the company is kind of diluting its shareholders, right, by issuing new shares each year. Okay, so let's jump to the exciting part, which of course is the valuation part. And we'll start off by looking at my key assumptions behind my bullish valuation for SuperMicro. So I'll start off with the revenue growth that I'm estimating for the company. I'm assuming 19% per year. Now that's much lower because over the past 5 years we saw 46% revenue growth, assuming that the company of course will become much bigger and then growth will also slow down. Now, on top of that, I'm assuming an EBITDA margin of 15% in 2034. In the past year, we saw 8%, and the average of the past 5 years has been 7%. So, assuming that the company will become more profitable as it scales and becomes bigger in the coming 10 years. And moving along, I'm assuming an enterprise value to EBITDA multiple of 10 times. We've seen in the past 5 years an average multiple of 15 times. So, as the company becomes bigger, more profitable, and as growth will slow down, I'm assuming a lower multiple as well. Okay, so moving on to the free cash flow assumptions, I'm assuming 22% average free cash flow growth in the coming 10 years. And that is, of course, much better than the minus 6% we've seen in the past 5 years. And this is a massive assumption. You need to believe that this company will at some point become free cash flow positive in the coming 10 years. On top of that, I'm assuming a free cash flow yield of 4%. That is how much free cash flow we get in relation to the share price. And finally, I'm assuming a discount rate when doing my future discounted cash flow analysis at 11%, which I think is quite fair for SuperMicro's stock. And with all of those assumptions, here you can see a detailed view of the yearly growth rates I applied to both revenue and free cash flow for SuperMicro stock all the way up to 2034. Now, I'm starting off assuming a revenue target of roughly $22 billion for 2025. That's in line with the company's guidance. And afterwards, I'm basically decelerating the revenue growth from 48% all the way down to 7% in 2034 in order to stay conservative. And the same logic I've applied for the free cash flow to equity. So I'm assuming a high rate for 2025 and then basically decelerating that growth all the way up to 2034 to 7% as well. We can see that the free cash flow growth will be slightly higher than the revenue growth all the way up to 2028, and in 2021 we can see that both growth rates essentially become the same, assuming that the company will become much more profitable, at least in the first few years, right? And using all of those assumptions, we actually can get two price targets for SuperMicro stock in 2034. We can get an enterprise value price target and a free cash flow price target as well. I usually just weigh them equally, and then we can get a weighted price target at roughly $165 per share in 2034. And as I started off in the introduction, all of these assumptions gives us a fair share price of today at roughly $104, showing us that the company is undervalued by close to 60% and that we can get 21% as an annual return from the stock all the way up to 2034. And I think this is quite interesting because 21% of course is beating the market. What you have to keep in mind is of course SuperMicro stock is extremely volatile. This is a stock that has massive upside and downside as well if it doesn't meet investors' expectations. In that sense, you have to ask yourself, is 21% sufficient to cover that type of risk and volatility that could impact your portfolio going forward? Here is a chart that shows us how the bull case could pan out for us as investors. We have to, of course, buy the stock today at the current share price plus any free cash flow we get for this year. Then we get free cash flow distributed to us each year, right, as dividends or buybacks or what have you. And then we sell the stock finally in 2034, and then we can see the total gains right in blue relative to what we invested today, showing us the massive upside that SuperMicro could have with these bullish assumptions. But before I add any stock to my portfolio, I like to look at the bear case as well. And here you can see to the left all the numbers I've already gone through in terms of the bull case. Now let's take a look at the bear case. In this case, I'm assuming revenue growth at 11%, and I'm also assuming free cash flow growth at 11% as well. And that gives us a fair share price of $32.4 per share, showing us that the company in that case is actually overpriced by 37% and that we as investors will only get 8% as an annual return. Now 8% isn't negative and it isn't really that bad, but keep in mind that these 8% will come with massive volatility. So with that said, you have to ask yourself, do you believe more in the bull case or the bear case? And that has to do more with your long-term view of AI and its implications on SuperMicro's revenue and profitability. Now, despite all of these bull and bear case valuations, a great stock, in my opinion, in its own essence, should have a few things. It should, of course, be a great business, and the stock needs to be well priced relative to your assumptions and forecasts. But the third element also exists, which I call momentum, which we'll take a look at for SuperMicro stock. Okay, so here we can see the stock chart of SuperMicro over the past few years. And yeah, in this case, I'd say that SuperMicro has some positive technical indicators going for it. We can see that the stock price, for instance, has come down right close to its long-term overall trend line. On top of that, we can see that the stock price is above this blue line, as you can see here, right? That's the 200-day moving average, showing us the average share price of the stock over the past 200 days. And if the stock is above, that's a good technical indicator. And if I zoom in a bit, we can see the upward sloping trend line here below, and we can see a downward sloping line of resistance. Hopefully, if the stock breaks above and stays above the 200-day moving average, that's a strong sign of momentum for the stock and a good time for new investors to start nibble at the stock and start building a new position. Now, if you're bullish on the stock but think that the stock price could still go down in the coming weeks or months, this table shows us what happens to the annual compound return. If the stock price goes down, that's green, that's good for new investors, or if the stock price goes up. And we can see that currently we have 21%. I think that's really attractive, but this is a volatile stock, right? Perhaps you would like a higher return for that volatility. If the stock would go down by 40%, I don't think that's likely, but if it happens, then you could get 30% per year, which is absolutely massive. Okay, so with that said, let's move on to my detailed rating. As I mentioned before, I gave the company a buy rating and a final star rating of 4.5 out of 5 stars. And yeah, here you can see all the key considerations behind my 4-star rating for SuperMicro stock. We can see, yes, strong revenue growth and strong EBITDA growth, but the company has not had strong free cash flow growth, at least in the past few years. Where the company has also received a low score has to do with the inconsistent stock performance. And lastly, in terms of valuation, yes, we have a high annual compound return, and we have a stock that is undervalued if you believe the bull case scenario that includes aggressive AI expansion and that SuperMicro becomes much more profitable in the coming years. But if you're leaning more towards the bear case scenario that I presented previously in the video, then yeah, you could make the case that the stock is overvalued today. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. And if you go down to the link in the description below, you get a free one-pager which includes 5 years of financial data, my full DCF assumptions, and the forecast summary as well. So yeah, thank you, and I'll see you in the next one.